Welcome to Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the SP 500. I'm going to cover the ASX 200 as well as copper, gold, oil and uranium in a separate video. I'll leave a link for that in the description section below. As always, everything today is general commentary only, doesn't take your personal situation into account. With all of that said, let's get into our first chart. So I've got the S&P 500 up here on the screen, and another week and another all-time high for the S&P 500. In fact, Thursday's all-time high was the 42nd for this year. Now, I'm sure a lot of people will hear that and think, wow, that is pretty extreme, 42 all-time highs. And yes, it is a lot, but it's not as extreme as it sounds. The most all-time highs in a year was 75. And that was back in 1995. Now, you might be wondering what happened the next year. Surely the market had to turn down after such a hot run. But do you know what happened? The market made 39 all-time highs the next year, and then 45 all-time highs the year after that. And then this sequence continued for several more years. And this is the thing with all-time highs. We get these clusters of them, and that's because that's how trends work. A series of all-time highs doesn't warn of a top. What a series of all-time highs is doing, it's telling us that the market is in an uptrend. Yes, a trend will ultimately end. Yes, there'll be corrections, there'll be pullbacks, all of that sort of thing will happen along the way. But what the data is currently telling us is that the path of least resistance remains to the upside. Just looking at this chart structure as it stands, we've got rising moving averages. I'm using a 50 and 100-day moving average pairing. We also have a series of higher highs and higher lows over the course of this year. They're both things that define bullish price action. There's always room for pauses and consolidations. We may well get a pause after this current rebound over the last 3 weeks. Always room for those. But at this stage, there's nothing here that suggests that we should change the game plan from being long equities. Now, I want to have a look at a different chart. I want to look at the S&P 500 in a different way. So this is, of course, the S&P 500 market cap index. Let's click over, have a look at the S&P 500 equal weight. Now, this has been my preferred measure of looking at the state of the market over the last few months. And the reason for that is the S&P 500, the market cap-based index, it's important. It's not to be overlooked. But the difficulty we have with that, particularly at the moment, is that 3 companies make up 20% of the index. And then the top 15 companies make up 40% of the index. I think that can make it harder to assess the performance of the broader market when you have such a large weighting towards just such a small number of those 500 stocks. Now, the equal weight doesn't have that problem, of course, because each stock is ranked equally. So what does this chart tell us? Well, unlike the S&P 500, let me just quickly go back to that for a sec. Unlike the S&P 500 market cap, which only broke above its July high, this is the July high here, only broke above the July high a week ago, coming back to the equal weight, here's the July high for the equal weight. The equal weight has made a series of all-time highs over the last few months. And I think this is a sign of broad participation, and I think that is also a key factor in a healthy bull market. Now, of course, other things to look at on this chart, again, we've got those rising moving averages of 50 and 100-day averages, and price is above the averages. So they're all bullish. They're all bullish signs. They're all things that we see in a bullish market. So I think rather than fearing the number of all-time highs we've had this year, I think it's a case of continuing to follow the established trend, which has been in place for some time now. We still need to manage risk, but I think the default position should be staying long until we have reason to do otherwise. Now, to finish up with, I've got a fascinating graph for you, something I think you're going to find pretty interesting. First of all, though, if you're getting some value, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. It tells YouTube you're watching. YouTube shows other people, helps me heaps. Please do that. Click that subscribe button if you haven't already done so. Now, moving on to that graph I just told you about. So I saw this through the week. It's from a guy called Charlie Billiot. Puts out some really interesting graphs, of which this is one of them. Now, what this does, it's showing the end of year predictions for the S&P 500 from some of Wall Street's top strategists. Now, of course, this year isn't over yet. Anything can happen. But as it stands, none of the 20 strategists have, well, so far, they've all been well short where the market currently is. So these are the end of year predictions along the chart. You can see where the market currently is at the end. Move to the far right of the chart, you'll see 5,733. That's where the market currently is. All these predictions have been, well, they haven't hit the mark. And just to put some perspective around this, the market closed in 2023 at 4,770. So when you think of that, some of the forecasts were actually looking for a fall, whereas most of them were optimistic, but not as optimistic as they could have been. That's at least as things stand now. Anything can happen over the next few months. Now, don't get me wrong. I'm not suggesting that the strategists did a bad job by any stretch. If you asked me at the end of last year, I wouldn't have got it either. I would have pitched it in the direction of the underlying trend, but I would have been too conservative. I wouldn't have suggested where the market currently is. So what do we take from this? What's the takeaway from this? For me, the big takeaway is be careful investing based on someone's prediction about what the future holds. Because the thing is, none of us know what the future holds. And what we think is going to happen in the future is almost always going to be different from what actually does. So yes, consider the possibilities. You can then apply strategies to maximize your profits to when you're right, and to minimize your losses when you get it wrong. But just to avoid rigid opinions, rigid predictions about what has to happen, because often, as we can see here, it doesn't play out the way you think it might. So look, let's call that a wrap for this week. Hopefully that's been interesting. I look forward to coming back, talking to you again next week. Till then, bye for now.